Picture this moment. You wake up, check the markets, and gold isn't up 2% or 5% or even 10%. It's up 40% overnight. Then another 30% by lunch. Then trading gets halted. Then it reopens and jumps another 25%. This isn't a rally. This isn't a bull market. This is panic. This is the moment when gold stops rising because of market forces and starts rising because the entire financial system is fighting for survival. Not a 10% increase, not even doubling. We're talking about a situation where the price simply stops having an upper limit. Here's what should terrify you. This has happened before in history. And the signs that it could happen again. They're already appearing right now in February 2026. Let me take you through what this looks like, why it happens, and why the conditions today are eerily similar to past breaking points. Let us start with a fundamental question that most people never think about. Why does gold have a price ceiling at all? The answer is simple, but profound. Gold has a ceiling as long as people trust currencies. Think of it this way. Gold is insurance. It's the financial fire extinguisher sitting in the corner. The dollar, the euro, the yen, these are the actual system, the main game. As long as that system appears stable, as long as people believe in it, gold behaves predictably. It rises slowly, maybe 5 to 10% a year in good years. It's boring, it's stable. It has a ceiling because there's no panic driving it. Gold is fundamentally a bet against the system. When the system works, gold is just another commodity with supply and demand dynamics. Mining production, jewelry demand, central bank purchases, normal market forces determine the price. But when trust in the system cracks, that's when everything changes. Let me give you the historical examples that prove this point. August 15th, 1971. President Nixon goes on TV and announces the U.S. is abandoning the gold standard. No more converting dollars to gold at $35 per ounce. The dollar is now purely a fiat currency backed by nothing except trust in the U.S. government. What happened to gold prices? In 1971, gold was $35 per ounce. By 1974, it hit $195. By January 1980, it peaked at $850 per ounce. That's a 24x increase in less than a decade. This wasn't a normal commodity price movement. This was panic. This was the market realizing that currencies were now purely trust-based and that trust could evaporate. The 1970s is the textbook example of gold without a ceiling. Inflation was raging, not the 3 to 4% we worry about today, but 13 to 14% annually in the US. The dollar was weakening. Oil shocks created economic chaos. Geopolitical instability was everywhere. Vietnam, the Cold War, the Iranian Revolution. People lost faith in paper money. They piled into gold. The price didn't just rise, it exploded. Every time you thought it had peaked, it went higher. And there was no ceiling because the ceiling was trust, and trust was gone. Fast forward to 2008. The financial crisis hits. Lehman Brothers collapses. The entire banking system nearly implodes. Governments have to bail out institutions that were too big to fail. Gold in 2008 was around $800 per ounce. By 2011, it hit $1,900, more than doubled in 3 years. Why? Because even though governments stabilized the immediate crisis, they did it by printing massive amounts of money and taking on huge debts. People looked at that solution and thought, this can't end well, I need insurance. The key insight from all these examples: the ceiling exists as long as the system is under control. When central banks can manage inflation, when governments can service their debts, when currencies maintain their value, when the financial system functions smoothly. Gold has a ceiling, it behaves predictably. But when that control slips, when trust cracks, the ceiling disappears. So what does it take for that ceiling to vanish? What has to happen for gold to go from rising asset to limitless panic bid? It's not just an economic crisis. We've had plenty of those. 2008 was massive and gold only doubled. We need something more fundamental. A crisis of trust, not just a crisis of economics. Let me walk you through the specific scenarios that could trigger this. Scenario 1, sovereign debt crisis. Here's the situation in February 2026. U.S. national debt is over $38 trillion. That's about 123% of GDP. Japan's debt is over 260% of GDP. China's total debt, government, corporate, and household, is somewhere around 300% of GDP. European nations are drowning in debt. But here's the thing, debt is fine as long as people believe it can be repaid. The ceiling disappears when markets stop believing that. Imagine this, a major economy, let's say Japan or Italy, faces a debt crisis. Bond yields spike because investors demand much higher returns to compensate for risk. But higher yields mean the government has to pay more to service existing debt, which makes the debt problem worse, which pushes yields even higher. It's a death spiral. Normally, that country's central bank would step in and buy bonds to suppress yields. But if they do that too aggressively, the currency crashes because everyone knows you're just printing money to pay debts. When this happens to a major economy, not Greece, but a G7 nation, the entire system's credibility is questioned. If Japan or Italy can't sustain their debt, and what about the US with its $38 trillion? What about everyone else? That's when gold loses its ceiling. Because people aren't buying gold hoping for a 20% return. They're buying it because they don't trust that their currency will exist in its current form in 5 years. Scenario 2, simultaneous currency crisis. A single currency falling apart? The system can handle that. We've seen it with the Argentine peso, the Turkish lira, various emerging market currencies. The dollar, euro, and yen stay strong, capital flows to safety, crisis contained. But what if multiple major currencies face crises simultaneously? Right now, in 2026, we're seeing the early stages of de-dollarization. China, Russia, Saudi Arabia, Brazil, they're all doing more trade in their own currencies or in yuan. The dollar's share of global reserves has been declining slowly but steadily. The euro has its own structural problems. Different economies forced into one monetary policy, with wealthy northern countries and struggling southern ones creating constant tension. The yen is in trouble because Japan has been fighting deflation and stagnation for decades, with zero interest rates and massive money printing. Now imagine a scenario where confidence in all three major currencies wavers simultaneously. Maybe it's triggered by a massive coordinated debt crisis, or a major war, or a catastrophic failure of the international financial system. Suddenly, there's no safe currency to flee to. The dollar is questionable, the euro is questionable, the yen is questionable. Even the Swiss franc and Singapore dollar can't absorb the trillions trying to flee. Where does that money go? Gold. But not gradually, in a stampede. Scenario 3, loss of inflation control. Central banks have one critical job: control inflation while supporting economic growth. They've generally succeeded at this since the 1980s. Even in 2021-2023, when inflation spiked, they eventually brought it back down with rate hikes. But what if they lose control entirely? We're not talking about 5% or even 10% inflation. We're talking about a situation where inflation accelerates and central banks can't stop it without destroying the economy. Where raising interest rates high enough to kill inflation would bankrupt governments because of debt service costs, destroy the housing market, and create mass unemployment. So they choose the lesser evil of allowing inflation to persist. Once markets realize that central banks have chosen to tolerate high inflation rather than fight it, because fighting it is too painful, trust evaporates. If the Federal Reserve, or ECB, essentially admits we can't control this without breaking everything, then holding cash or bonds becomes actively stupid. That's not a 2x move in gold. That's gold repricing to reflect that paper money is fundamentally losing its function as a store of value. Scenario 4, the paper gold versus physical gold crisis. Here's a scenario that keeps precious metals experts up at night: the breakdown between paper gold and physical gold. Right now, most gold trading isn't actual physical gold changing hands. It's paper contracts, futures, ETFs, certificates that represent claims on gold. It's estimated that for every ounce of physical gold, there are 100 plus ounces of paper claims. This works fine, until everyone wants physical delivery simultaneously. Imagine this. A major crisis hits. Investors in gold ETFs start demanding physical delivery instead of just holding paper. Central banks accelerate their gold purchases. Wealthy individuals want their gold in private vaults, not in some bank's custody. Suddenly, there's not enough physical gold to meet all these claims. ETFs might have to suspend redemptions. Futures markets might force cash settlement instead of physical delivery. The price of actual physical gold in your hand diverges massively from the paper price on exchanges. This breaks the market, because once people realize that their gold investment might not actually be convertible to real gold, panic sets in. The price of physical gold goes parabolic, while paper gold becomes essentially worthless. Let's get concrete. What does it actually look like when gold loses its ceiling? How does it play out day by day? This isn't a smooth, linear rise. This is panic. This is repricing. This is the market having a psychological break. Day 1. The catalyst. Something breaks. Maybe it's a major sovereign debt crisis. Maybe it's a currency collapse. Maybe it's a geopolitical event that shatters confidence. Whatever it is, it's big enough that markets immediately recognize this isn't normal. Gold opens up 8% overnight. That's a big move, traders think, but we've seen this before. By midday, it's up 15%. Now people are paying attention. By market close, it's up 22%. That's not normal. That's concerning, but still within the realm of extreme volatility rather than system breakdown. Days 2 to 5, the acceleration. Gold doesn't pull back, it keeps rising. Up another 18% the next day, then 25% the day after. Now the commentary changes. Financial media stops saying gold is having a good run and starts saying unprecedented gold rally raises questions about financial stability. Central banks issue statements about maintaining orderly markets and having adequate reserves. These statements have the opposite effect. They confirm people's fears. Wealthy individuals and institutions start demanding physical delivery. Gold dealers report being completely sold out. Premiums for physical gold over the paper price start widening dramatically. Week 2. The system responds. Exchanges implement special measures, circuit breakers that halt trading when gold moves too much in a day, increased margin requirements for futures. Some ETFs suspend new creations or redemptions. These measures are meant to stabilize markets. Instead, they create more panic. If the system is restricting our ability to buy gold, that means gold is exactly what we should be buying. Central banks hold emergency meetings. Some start selling gold reserves to try to cap the price and restore confidence. It doesn't work. The market just absorbs the selling and keeps rising. Week 3 to 4. The new reality. Gold has now tripled from its pre-crisis level, and it's still going up. But here's the crucial shift. It's not trading like a commodity anymore. It's trading like currency itself is being repriced. News headlines stop reporting gold's price in dollars and start reporting dollars' value in gold. Dollar loses 65% of value against gold this month is a very different framing than gold up 200%. But they're the same thing. The psychological shift matters. Some countries start discussing backing their currencies with gold again, not because they want to, but because their currencies are collapsing and they're desperate for credibility. Private transactions start using gold as reference. Real estate might be priced in gold ounces. International trade deals reference gold rather than dollars. The formal monetary system hasn't changed, but people's behavior has. The ceiling is gone. At this point, asking, what's gold's ceilings, is like asking, what's the ceiling on how much trust can be lost? There is no ceiling because this isn't about supply and demand for a commodity. This is about the repricing of every fiat currency against the only form of money that doesn't depend on anyone's promise. Every morning, the question isn't, will gold go up? It's how much will it go up today? Why this could happen in this decade. All right, let's bring this back to reality. Why am I telling you this in February 2026? Because the conditions that could trigger this scenario are already in place. Not hypothetical future conditions, actual current conditions. Total global debt in 2026 is over $315 trillion. That's about 340% of global GDP. This is unprecedented in peacetime. The US has $38 trillion in debt and growing. Every percentage point increase in interest rates adds hundreds of billions to annual debt service costs. At some point, the math stops working. Japan's situation is even more extreme. They've kept interest rates near zero for decades because raising them would bankrupt the government through debt service costs. They're trapped. China's total debt load, government, corporate, household, is massive and growing. Their property sector, which represents a huge portion of household wealth, is in crisis. Europe has structural debt problems in Italy, France, Spain, and Greece that never really got solved, just papered over. This much debt means the entire system is fragile. One major default or crisis could cascade. The dollar's role as global reserve currency is being actively challenged for the first time since World War II. China and Russia are settling trade in yuan and rubles. Saudi Arabia is accepting yuan for oil sales. Brazil and Argentina are discussing a common currency. India is using rupees for trade with multiple partners. Even U.S. allies are diversifying reserves. Central banks globally have been net sellers of U.S. treasuries and net buyers of gold for several years now. The dollar isn't going to disappear overnight, but its dominance is eroding, and that erosion creates instability. Here's a crucial signal. Central banks are buying gold at the fastest pace in decades. In 2022, they bought over 1,000 tons. In 2023 and 2024, similar levels. In 2025, it accelerated further. China, Russia, Turkey, India, Poland, all massively increasing gold reserves. Why? Because they see what we're discussing. They're preparing for a world where currencies are less trusted and gold matters more. When the institutions responsible for managing currencies are stockpiling the alternative to currencies, that's a signal. The world is splitting into competing blocs, US versus China, NATO versus Russia. The unified global system that emerged after the Cold War is fracturing. This matters because a unified system can coordinate responses to crises. A fragmented system can't. If the US, China, and Europe aren't cooperating, then containing a financial crisis becomes much harder. Worse, in a fragmented world, countries weaponize finance, sanctions, frozen assets, restricted access to payment systems. This makes everyone trust the system less. If you're a country or a wealthy individual and you've seen the US freeze Russian central bank reserves, you think, could that happen to me? The answer is maybe. So you diversify into assets that can't be frozen or sanctioned, like gold. Maybe the most important factor, people trust institutions less than ever. Trust in governments, central banks, media, corporations, all declining. Conspiracy theories and skepticism are mainstream. People question official inflation numbers, official economic data, official explanations for policy decisions. This matters because the modern financial system runs on trust. Fiat currencies are trust, bonds are trust, the stock market is trust. Banking is trust. When trust erodes, the system becomes fragile. It doesn't take much to tip it over. Here's what you need to understand. Gold's price doesn't rise by itself. It rises when trust falls. Gold at $2,800 an ounce in 2024, or $3,000 in early 2025, or even the $5,000 we're seeing right now in February 2026. These are prices in a system that's still functioning, even if it's straining. These prices assume currencies still work, governments remain stable, central banks maintain control, and debts can somehow be managed. But look at what's already happened. Gold has nearly doubled in just over a year, from $2,650 in December 2024 to $5,000 now. That's not normal market behavior. That's not jewelry demand or mining supply issues. That's fear. That's the early stage of trust cracking. And here's what should terrify you. We're still in the functioning system phase. Central banks are still in control, barely. Currencies still work, mostly. The financial system still operates, just with more stress than before. $5,000 gold is expensive. It's a record high. But it's still a price in a world where the dollar exists, where bonds are traded normally, where the system limps along. But if the day comes when trust in that system cracks globally, not just one country in crisis, but the entire interconnected financial system losing credibility, gold doesn't just rise anymore. It reprices. Because at that point, gold stops being an investment you hold for returns and becomes an alternative monetary system. It becomes the thing you measure everything else against, rather than being measured in dollars. The ceiling disappears because there is no ceiling to how much trust can be lost. Think about it. Gold went from $2,750 to $5,000 in about 14 months. That's an 88% increase. And that happened while the system was still working, while central banks were still maintaining order, while people still broadly trusted that their dollars and euros would exist tomorrow. What happens when that trust breaks? Not weakens, breaks. We've already seen the warning signs that brought us to $5,000. U.S. debt hit $38 trillion with no plan to stop it growing. Central banks globally bought over 1,100 tons of gold in 2025, the second highest annual purchase on record. Dedollarization accelerated, with more countries settling trade outside the dollar system. Inflation remained sticky, refusing to come down to central bank targets despite high interest rates. Geopolitical tensions intensified, making the global system more fragmented and less cooperative. Those factors got us from $2,650 to $5,000. They shifted gold from alternative investment to essential insurance in many investors' minds. But we haven't seen the real crisis yet. $5,000 gold is expensive, yes, but it's not panic, it's not repricing, it's not the ceiling disappearing. Here in February 2026, we're closer to that edge than most people realize. The debt hasn't become sustainable, it's gotten worse. The geopolitical situation hasn't stabilized, it's more volatile. De-dollarization hasn't slowed, it's accelerating. And those central banks buying gold, they're not doing it because they think gold is a good investment. They're doing it because they're preparing for something. I'm not saying the collapse will definitely happen. I'm saying the conditions are in place for it to happen. The system is under more stress than the $5,000 gold price even suggests. The kindling is stacked, soaked in gasoline, and someone's playing with matches nearby. When that day comes, if it comes, you won't have time to react. By the time you realize gold is in a true no-ceiling scenario, it won't be $5,000 anymore. It will be $8,000, then $12,000, then $20,000, moving faster than you can process. Physical gold will disappear from dealers. Premiums will explode. ETFs might suspend redemptions. Governments might restrict gold purchases or exports. The move from $2,150 to $5,000 took 14 months and felt fast. The move from $5,000 to $15,000 could take 14 days if trust really breaks. So maybe, just maybe, it's worth thinking about gold, even at $5,000, not as an investment you're buying for returns, but as insurance for a scenario we hope never happens, but increasingly looks possible. Because if that day comes when gold's ceiling truly disappears, when we go from $5,000 to something unimaginable, the question won't be, how high can gold go? The question will be, how much is paper money really worth? And you won't like the answer. The fact that gold is already at $5,000 in February 2026 isn't proof that the crisis has passed. It's proof that it's beginning.